afternoon, everyone. Thank you for joining us for session 2. I'm Eunmi Park from AMRO, and I'll be moderating for this session. Banking sector digitalization is reshaping financial landscape. It brings new opportunities, but it brings new risks. So today, we aim to explore how to encourage the banking sector innovation while maintaining financial stability. Our session will begin with a presentation by Dr. Runchana Pongsaparn, followed by another presentation by Pak Adrian Yusuf, and then a panel discussion with our distinguished panelists. Let me now introduce our first presenter. Dr. Runchana Pongsaparn is the Financial Surveillance Group Head and Lead Economist at AMRO, leading our work on financial surveillance and AMRO's flagship ASEAN+3 Financial Stability Report, AFSR. She has also been mission chief for Japan, Malaysia, Singapore, and the Philippines. Dr. Runchana has extensive experience in financial sector issues, financial stability, macroeconomic assessment, and monetary policy at AMRO, the IMF, and the Bank of Thailand. Today, she will speak on banking sector in the digital age, balancing innovation and stability. Runchana, the floor is yours.
Thank you very much, Eunmi, for the introduction, and good afternoon, ladies and gentlemen. So in the first presentation here, we would like to share with you our main findings in the third chapter of our ASEAN+3 Financial Stability Report. This was launched in early October. So let me also say that we benefit a lot from the inputs from OJK as well as Bank Indonesia in completing our report, especially on the part of Indonesia. So thank you so much, OJK as well as BI. So for this presentation, there's actually the key highlights here. We're looking at how digital transformation come about, and it seems that the key drivers of the digital transformation is not only the supply side, but also the demand side, as well as the policy support from the authorities. So basically, from the supply side, we have the technological development. From the demand side is the consumers who demand better product, better services, and so on. And then with the regulators providing the support in order to propel the digital transformation forward. So with the digitalization, we have many new players, such as fintech, big tech, or even the incumbent banks themselves also develop a lot of digital applications and so on to catch up with the rest of the industry. So everyone is playing an important role in the digital transformation process. But of course, with the innovation, we also have evolving risk coming with the innovation. The benefit of innovations come with the risk. So the two sides of the same coin. So in terms of the digitalization is affecting the market structure, certainly, and it changed the nature and the distribution of risk associating with the banking sector as well as the financial stability. Among the key risks are actually cybersecurity, fraud, scam, and so on. It has increased significantly with digitalization. At the same time, we still have the traditional risks like liquidity, concern, credit risks, and so on, which is associated with the banking sector itself. So in terms of the policy, our findings suggest that, of course, the policy framework would have to achieve the good balance between innovation and stability. But at the same time, we have to catch up with the evolution of the risk. So authorities would need to work together with the private sector to make sure that we can mitigate the evolving risk in time and prevent the contagion. So these are the key highlights from our chapter in the AFSR. So I'm going to go through the findings quite quickly. So in this first page, we compare across the region. And we find that digitalization, when we talk to the different authorities, and find out that there's a lot of push from the regulatory side, from the demand supply side. And when we compare across country here, you will see that for Indonesia, you have the advantage in terms of the young population and still high potential for the digitalization to integrate into the banking services. So with the relatively large unbanked population, that's where the potential area of the reach out for digitalization. And the young population who are tech savvy. So they are more, they're very convenient in investing in digital assets as the morning session has suggested. And at the same time, they're more savvy to develop the digitalization as well. And with the different technological process in many areas like cloud computing, API, mobile phone, AI, DLT, then we have many more players coming into the banking services like big tech, fintech, tech firms themselves. So it's not just the banks or financial firms, but also the different type of players enabled by technology. They can participate in providing the banking services from the digital point of view. So we can see that from the left-hand side, actually the fintech revenue has been growing very fast, especially in Asia. And on the right-hand side, we see here that digital wallets and digital payment has been growing rapidly, especially in ASEAN plus 3. So where's the traditional bank standing? Basically, traditional banks, what they do is they also invest a lot in the technological side. So you will see on the left-hand side, there's a significant increase in the investment in technology. And on the right-hand side, you see that the traditional brick and mortar branches has been declining over time. And in this chart, we're looking specifically at the digital banks. So you will find that in our publication, we focus quite a lot on the digital banks. But in this country, in Indonesia, we do not have the separate license for digital banks. But digital banks do have the same license as traditional banks. So this is why we say digital first banks. So that means banks who operate using digital means as the main mode. So what we see here is that on the left-hand side, the ownership pattern of these digital banks come from everywhere. Tech firm, financial institutions themselves, or other type of firms. And in the middle chart, you also see that the market share of digital banks, actually it seems to be quite small. But in the case of Korea, where digital bank has been developed, decades ago. So Korea was among the pioneer in terms of digital bank, Kakao and so on. So this is why the share of digital banks in Korea has been relatively high compared to other countries. But in other countries, Indonesia included, we're still in the early stage. And talking about the capital adequacy ratio in terms of how resilient digital banks compare to traditional banks, actually digital banks are being required to hold relatively high capital because of the credit risk, which I will get to a bit later. So on this slide, we're comparing digital banks in ASEAN plus 3. Across the region, we have all the different types in terms of the licensing. Some have separate license for digital banks themselves. Some are using the same. So for many countries, like for example, Thailand, or for Singapore, Thailand, and so on, they would have a specific license for digital banks. But for Indonesia, they don't do the specific license. So I leave out the detail here, just for the sake of time. In terms of the risk associated with the digital banks, what we found from the survey of authorities across ASEAN plus 3 countries is that the risk that is most concerned for the authorities and regulators are actually operational risk. So other risks still remain, like pro-cyclical risk, systemic risk, business or credit risk. They are still there, but people are more concerned. With the digital banks, the operational risk is probably number 1. Then when we talk about the cases of cyber attacks, that goes with the operational risk, right? So operational risk refers to fraud, cyber attacks, scams, and so on. It has been on the rise. This is the right-hand side chart. And in terms of the cyber attacks, actually financial industry has been the target of the cyber attack as well, and especially of the exploitative nature, meaning they're trying to get the information from you and then exploit those information to their own benefit. So this has been on the rise across the region. So having said that, we are talking about increasing cases of frauds and scam and so on. So what do we do about it? Many countries actually trying to strengthen the loss sharing framework. So every party, all the stakeholders would have to have their fair share of the loss facing the customers. So I'm not going to go into details, but yes, certain frameworks are quite interesting that banks, tech firms, etc., will have to be responsible for the loss, along with the customers. Talking about credit risk, I mentioned that digital banks do have to hold relatively high capital ratio. This is partly because with the digital banks is the new operation, and for many of them, they do not have access to the credit history. So they would have to rely on alternative data to do credit scoring and so on. And at the same time, trying to survive in the environment where you already have the incumbent banks who have a larger share of the customers. So you usually end up with a very competitive environment when digital banks were trying to attract customers by giving high deposit rates, while at the same time the loan rate could be lower. So in this case, we find that for those digital banks who just started, for example, in the Philippines, the NPL is relatively higher than the traditional banks. That is partly because it's more like the trial and error period before it stabilized. Another risk concerning the banking sector is also liquidity risk. So we're comparing here SVB. If you remember, in 2023, SVB collapsed. Also, there was a case for Credit Suisse and so on. So those in red dots are the ones who recently collapsed, right? And then the one in green dots are those who collapsed during the GFC. So on the y-axis, we represent how fast it is in terms of the deposit outflows. So we see that the red dot seems to be well above the green dot, which means that recently the deposit outflow actually more significant during the recent episode than the earlier episode, which means that the bank run can take place, quite rapidly nowadays because of the digitalization as well. And for this slide, we compare the regulatory development across the region. So most of us, for the basic banking services and technology, we do have the regulatory framework in place. But for those new technology like DLT, AI, machine learning, open banking, and so on, we're still quite lacking behind. So this is probably the area for further development for regulators. And at the same time, the regulations itself would need to fit the country context. So we have the variety of the regulatory approach in this region. And finally, come to the last slide. How do the authorities or regulators address this risk? For example, in terms of the operational risk, talking about cyber attacks, so on, of course, we need to implement the IT standards and incident resolution that is effective and can address the problem promptly. And of course, the weakest link is probably the customers. So we need to make sure that we have financial and digital literacy on the part of the customers. And introduce the loss sharing agreements if you don't already have one. In terms of the liquidity risk, we encourage that vendor and partner should be diversified, because talking about vendor and partner in terms of the technology is usually concentrated in certain companies. So this should be more diversified to make sure that we don't have the systemic risk. At the same time, digital banks should demonstrate the intraday liquidity management and recovery planning, because it can go really fast in terms of deposit outflows. So we have to make sure that we have planned liquidity management for that. And the communication will be very important. If there's any event that's happening, communication will help calm the market. In terms of the credit risk, prudential practice will be important. And even though we want to develop the alternative credit scoring model, then it should be done, of course, properly, and data sharing across units would be very important. In terms of the business risk, of course, if digital banks cannot survive, we have to make sure that there can be the orderly exit for the non-viable business. And governance framework is very important. So let me stop there. Thank you.
Thank you, Runchana, for that insightful and comprehensive presentation. Let me now introduce our next presenter, Adrian Yusuf. Adrian is Deputy Director and Principal Economist in the Macroprudential Policy Department at Bank Indonesia, working on macroprudential policy, financial stability, and banking sector issues. He has served in key roles across BI and OJK, including on task forces for Indonesia's G20 presidency, ASEAN chairmanship, and financial assessment program for Indonesia, and represents Bank Indonesia in major international forums. Today, he will elaborate on the macro-financial backdrop, Indonesia's digital lending landscape, and Bank Indonesia's measures to mitigate digital risks. Adrian, the floor is yours.
Yeah, thank you, Eunmi, and thank you for the kind introduction. Good afternoon, ladies and gentlemen. First of all, I would like to thank OJK, Ministry of Finance and Economy, Republic of Korea, and also AMRO for inviting BI to this wonderful event. Pretty much these days, we talk about geopolitical risk, uncertainty, and then also the future of US monetary policy given the new Fed chair is coming, and also all the implication from the tariff. So this landscape, these conditions affected Indonesia and also the global in terms of capital flows, in terms of value chain and so on. So this is pretty much the picture of what we are, or where we are at the moment in terms of global landscape. And just recently also, the FSB announced that one of the vulnerabilities that we should be monitoring closely is the digitalization related vulnerabilities. This is, this is normal because we've seen a rapid adoption of technology in the financial sector and also in all aspects of the economy. So why digital is very important for Bank Indonesia as well is because from the two sides of the coin. So first one is on innovation to support or to promote the growth of the industry and also the economy. The second side is also on the stability aspect. We've seen frauds, we've seen data breaches, security breaches, we've seen cyber attacks, and also affecting the operational risk that Dr. Pongsaparn mentioned earlier. So this is pretty much the landscape that we are currently in. And on the next slide, this is my first slide. And on the next slide, despite the global headwinds that I mentioned earlier, Indonesian economy remains solid in terms of growth, and also, however, we cannot be complacent because everything or many needs to be continuously improved or increased. So in the fourth quarter, as you may also know, our growth is 5.04, slightly moderating from the previous, from the second quarter, but we are optimistic in the fourth quarter it will be better, given all the, the efforts from the private sector, from the government, from BI, from OJK to support the economy. And in terms of also from exchange rate, rupiah is less volatile compared to others. And also, if we look at the PMI manufacturer, we are still in the expansion mode. Inflation is also under control. So in terms of fundamental of the economy, Indonesia is in good shape to weather the headwinds that we are currently and also probably next year facing. In the next slide, I would like to touch briefly on the banking sector. So overall, the banking sector is resilient. We know that one of the major issues related to intermediation to credit, it's slowing a bit in October, but we are optimistic based on our discussion with the industry, with banks, that we will reach within our projection limit, which is 8 to 11%, but it's more on the lower part of the projection. And in terms of the capital, as mentioned also Dr. Pongsaparn, the capital is quite solid, 26%, and our latest stress testing is also come up with encouraging result. So. On the next slide, so the role of digital banks in financial intermediation is expected to increase. So the digital bank lending is supported by the indirect lending through a digital ecosystem and also strengthened by low credit risk and also dominated by productive loans. We've seen the fintech lending continues to grow also, although at a slower pace. And also the consumer sector remains the main driver in this trajectory. So this is a bit on the, I think the story is the same with Dr. Pongsaparn mentioned that the NPL in the digital bank is lower than the overall of the industry. So it is encouraging sign from the digital bank perspective. So on the next slide, I want to mention that the accelerated digital payment adoption is projected to be exponential in the coming years. It is projected to be 14 times higher than current at the end of 2030. But we also face problems and challenges that demand our stronger or effective policies. The first one is strengthening the modernization of digital payment infrastructure. This will improve safety, resilience of the digital infrastructure, which will enable a greater intermediation role. And the second one is the enhancing industrial structure, including the interlink between banks and non-banks. This will ensure the integrated and enhanced monitoring and address potential regulatory arbitrage and systemic risk in the financial system. And the third one is strengthening collaboration with the industry and in innovation and risk management. This is important to collaborate with the industry because we have to listen to the industry, what their needs, and how we can support them to grow their business and also to manage the risk. In the next slide, I would like just to highlight several initiatives that Bank Indonesia has been initiated. We have SNAP, we have BI Fast and QR Indonesia standard, and also the electronification and regulatory reform underway under our national payment system blueprint. And it shows tremendous growth of the industry and also delivering a remarkable result to the digital payment ecosystem and also to the economy. If we look at the digital payment, it's 3 times of the GDP on the lower right of the screen, and also the digital banking banking digitalization. I mean, is 90% of the commercial bank have a digital channel now, and also financial inclusion. So of course, digital banking will support, and the digitalization will support financial inclusion at the end of the day. So let me touch on how we see the financial stability from our macroprudential policy mandate. So in Indonesia, financial intermediation inclusion are important elements to support financial system stability. So we are not, from our perspective, from Indonesian perspective, it's not just about resilience of the bank that support the financial stability, but it's also the financial intermediation and also the financial inclusion. That's what unique to Indonesia, because we've going through several crises, right? And intermediation is one of the key elements that we see affecting the financial stability in Indonesia. That's why under our framework, based on the financial sector omnibus law, financial intermediation is part of the financial stability framework that Bank Indonesia is being mandated. So the goal is to contribute in maintaining stability of the financial system in order to support sustainable economic growth. So in these goals, you can see that this is the balance that we have been talking about in this panel. So we are not just talking about risk, we are talking about how to support the economy, how to support the economy to grow in sustainable manner. That's the first one. And the objective is, as I mentioned earlier, we have 3 pillars. The first one is optimal credit and financing. The second pillar is on the stable financial system, which is the resilient part, and also on inclusive and green financing. So this is pretty much what we are working on as a macroprudential policy authority in Indonesia. Of course, we are not doing this alone. We are doing this with the OJK, with the government, with Indonesia Deposit Insurance Corporation to address the complex nature of Indonesian financial sector and also the economy. And also, as mentioned by Dr. Pongsaparn, we are addressing not just on the supply side, because regulatory perspective is addressing issues from the supply side of ensuring liquidity, ensuring the banks can lend their efficiently and so on. But we are also working with government, with OJK, with other relevant stakeholders to address the demand side. We are seeing the growth of the economy is slowing down in the world. So this is on the demand side. This is something that we have to work together. On this last slide, I would like just to mention a bit about framework and regulation on cybersecurity and fraud that Bank Indonesia has issued. So the IT risk profile, if you see on the left top of the screen, IT risk is now an integral component of BI supervisory cycle. So, and also BI has issued regulation on fraud management system and payment system providers. As you may look at the right picture, we are providing guidance on transaction level, on account level, and also on network level. And also, as I mentioned, we are not doing this alone. We work this with OJK, with other authorities. We have the so-called Cyber Incident Response Team, or in Bahasa is TTISSK. It is a platform for OJK and BI to work together with the industry to address any cyber incident, any cyber attack that are happening in Indonesia, so that we can, mitigate it from the occurrence in the future. And also, we are working closely with other government agencies. And one thing that I also mentioned is that every aspect of financial stability is being discussed, being coordinated under the Financial System Stability Committee, the KSSK, comprising Bank Indonesia, OJK, Ministry of Finance, and also the Indonesian Deposit Insurance Companies. So nothing loose from our side in Indonesia in terms of financial stability. So we work together, we compare notes, and also we synergize our policies so that the policies are becoming complementary rather than competing each other. So I guess that's my preliminary presentation. Thank you so much, Eunmi.
Thank you, Pak Adrian, for a very rich and informative presentation. So before we start our panel discussion, let me briefly introduce our panel. First, Dr. Runchana Pongsaparn of AMRO, whom you've just heard from. Next is Mr. Edmund Chu, Associate Economist at AMRO and co-author of the AFSR 2025 chapter on banking sector digitalization, as well as a policy perspective paper on the ASEAN Regional Payment Connectivity Initiative. And next is Pak Adrian Yusuf from BI, whom you've just heard from, and Mr. Sajal Bhatnagar, a digital director at Allo Bank Indonesia. He has led Allo Bank's digital business since its launch in 2022. Before joining Allo Bank, he held senior roles in India's digital finance sector, including Chief Business Officer at Paytm Payments Bank and Vice President at Paytm. Thank you all for being with us. To kick off the discussion, let me start with a question for Runchana. Runchana, thank you for your presentation. It is very interesting to see that the banking services have evolved rapidly with digitalization in ASEAN+3 region. The key takeaway is how to strike the balance between innovation and financial stability. Runchana, as you have shared with us, digitalization has brought significant changes to banking services. How do you see the financial landscape evolving with financial digitalization in ASEAN+3? With new players of different types participating in new financial landscape, what do you see as a potential endgame?
Okay, thank you very much, Eunmi. This is something that everyone is excited about, right? What's the end game? But before getting there, so let me say that as we can see that there has been a lot of new players coming in, new product with digitalization because of the digital innovation that allowed them to do so, like the fintech, big tech, and so on. So with this increasing competition, actually large banks or incumbent banks themselves also competing by adopting the new technology and so on. So one thing that I see as the changing financial landscape is that we have increasing role of the non-bank players, especially the digital players. But the fact that they mainly concentrate on the retail side or SME side, so the share of the overall asset will remain relatively small. And going forward, over the next few years, I still think that banks still going to dominate the financial system. And what's the end game? This is interesting. So the fact that incumbent banks, they also develop their own technology, right? And at one point, they will be able to address all the demand for the different services. So we probably end up with something like what we call barbell financial structure, which means that on the one end, we have the really large players who will be providing variety of services. And at the other end, we probably have the niche small market player who providing the niche products. So this is the end game that I can see right now. Thank you.
Thank you, Runchana. You've highlighted the competitive landscape is evolving, not only through digital bank, but also to fintech and big tech companies, which may complement or challenge the traditional banking sector in different ways. Edmund, digitalization clearly brings both risks and opportunity. From your perspective, what are the biggest opportunities for the financial sector, particularly in banking services? And what are the most significant financial stability risks that have emerged alongside this shift?
What I'm going to talk is actually the extension to what to Runchana's what I have presented. So first, want to sort of understand what's the ages of the demographic and mobile penetration, which ASEAN possess have provided a strong foundation for financial digitalization to flourish in ASEAN. So ASEAN has a young mobile native population and high rates of internet and smartphone penetration that have created a large base of tech-savvy consumers. So, significant unbanked and underbanked population have made financial inclusion a government priority across many emerging economies in ASEAN. So, taken together, so those advantages has presented regional banks and service provider a lot of opportunities to bring these demographic segments on board financial platforms. So by partnering third-party service providers or developing their own credit scoring models, they are able to leverage on the technology and growing pool of data to assess creditworthiness of consumers and small businesses and extend financial services to them. So apart from financial inclusion, digitalization also promotes efficiencies and reduce transaction costs for banking services. So that's a key benefit which are driving demand. So how does digitalization improve efficiency? So mainly through 3 channels. So technology developments have enabled fintechs and big techs to innovate and compete with traditional banks, especially when disruptions comes in direct competition for the same services. Then also digital banks leverage on their corporate ecosystems such as e-commerce, non-bank financial services, and ride-hailing services to cross-sell their products and reduce customer acquisition costs. Then digitalization also can unbundle and rebundle financial intermediation with new technology providers along the chain, providing specialized yet cost-friendly services. Having said that, the banking sector digitalization could also create new financial stability risks or change their nature and distribution. So based on the survey we sent to ASEAN plus 3 authorities, it showed that operational risks are the most pronounced, followed by systemic risks. ASEAN policymakers are also more focused on credit risk. So let me touch on these 3 risks. So operational risk is a risk of loss resulting from inadequate or failed internal process, people and systems, or from external events as well. So these include cyber risk, fraud, and model risk. So digitalization has actually improved cybersecurity. However, it also increased the number of digital touch points, potentially increasing cyber risk. Data has shown that reported cyber attacks in the region have been on rise since 2014. Next is digital fraud, which are especially relevant for ASEAN economies, as our region have actually suffered financial losses up to $24 billion USD last year due to scams. and this year the losses might have risen. The scams are mostly committed by organized crime within Southeast Asia, who use technologies such as malware, Gen AI, and deepfakes. So model risk refers to the potential for financial losses arising from flawed or inappropriate use of models used by fintechs and banks. So the current models may have poor predictive accuracy, particularly during black swan events. And the quality of the training data also quite important. It can influence model outcomes and lead to biases. The next risk I want to touch on is systemic risk, which have involved from being an outcome of interconnectedness between the financial institution alone to being dependent on non-financial corporates, such as technological service providers. So this collaboration has actually produced vulnerabilities in data and transaction security, privacy concerns, as well as inconsistent cybersecurity standards. So such added layers of as complexity and opacity has made it more challenging for regulators to identify, assess, and respond to emergent risks. Finally, I'll touch on credit risks, which have arisen in fintechs and digital banks due to key developments such as catering to unserved or underserved population, the use of alternative credit scoring mechanism, and innovative lending structures such as buy now, pay later, and P2P lending. So using alternative credit assessment methods allows fintechs and digital bank in ASEAN to target unbanked and underbanked population and avoid direct competition from incumbent banks. However, it also increases the risk of adverse selection and loan defaults. So these financial institutions also lack physical innovations, which could pose challenges in loan collections. However, we in AMRO view that currently credit risk is not yet a major concern for most digital banks across the region. However, close monitoring is still warranted where loan loss buffer are thin.
Thank you, Edmund. You pointed out the opportunities like greater inclusion, innovation, and efficiency, but on the other hand, there are risks like systemic risk, operational risk, and credit risk, something like that. Thank you. And Pak Adrian, thank you for your presentation. It seems that the banking sector digitalization has become a very important issue for authorities to maintain the macroprudential soundness. From a macroprudential point of view, how does BI view the rise of digital banking and fintech innovations? Are there any areas that you consider particularly relevant for systemic stability?
Yeah, thank you, Eunmi. It's a good question. Just last week, if you had the opportunity to watch or attend it, Bank Indonesia held this annual gathering where our governor laid out advice to the government on how we go about our economy and financial sector in 2026 and beyond. So he mentioned 5 strategies, and 3 of them are relevant to our topics this afternoon. The first one is how we need to ensure stability, and the second one is how we need to support the financing to the economy, and the third one is how we need to promote digital economy, ecosystem, and infrastructure. So that's pretty much of what our advice to the government in terms of financial sector, how they can contribute to the economy. Coming to your question, Eunmi, so from BI perspective, we see it from the 3 pillars that I presented just now. So first one is on the resilience. So in this pillar, we need to ensure that the banks, the digital banks, they have the proper risk management framework in place. They have effective QIC and AML policy in place. They need to have a governance, data security, and cyber resilience. with the rapid technological adoption, the economy and financial sector, we need to be mindful of the cyber resilience, operational resilience that Edmund mentioned, and also concentration risk and the third-party risk management. If you look at cases where the cyber attack or cyber incidents happening, in many cases it involves a third party, it involves breach to the system, and it involves a human factor. So all of this must be integrated into the resilient part of the digital bank. The second and third part is on intermediation and also on the inclusion. So we want to make sure that the banks, they can perform their intermediation function and also the inclusion role to the economy. So because this is the essence of the banking industry, right? So intermediary between the deficit and surplus units. So in BI, we are monitoring and stand ready to support the industry whenever there is impediments to the intermediation and also to the inclusion. In terms of policy, we have issued the Macroprudential liquidity incentive policy and deploy policy mix. So policy mix meaning that we are integrating, we are combining, we are synergizing BI, monetary, macroprudential, and also payment system policy to support the economy, to ensure the stability. That's and one of the important elements I mentioned also in my presentation is about coordination with the government and also with other financial sector authorities. This is very important for our financial system. Yeah, I think I mentioned I answered all of it, but if welcome if you have further.
Thank you, Adrian, for the valuable insight from as a point of authorities. And Mr. Sojal, you waited for a long time. Okay, digital banks are often expected to grow rapidly and innovate while maintaining prudential soundness. How do you balance the pressure for rapid customer acquisition and product innovation with the need to keep credit standards, cybersecurity, and overall risk management strong?
Thank you, Eunmi. I'll try and keep it brief because we are running short on time. But to answer your question, I'll first take a step back and address why we as digital bank exist in this region, generally why we as a digital bank exist. The main reason is we are here to serve the underbanked or serve an under-penetrated product and take us to large customer segment using technology. Now, this brings a unique set of characteristics. Basically, when I use technology to serve banking, what I'm doing is I'm putting a lot of capital expense in the beginning, which basically means there's a bit of high cost in the beginning, but the cost of incremental customer acquisition is minimal, right? I can have 10 customers, 100 customers, 10,000 customers, 10 million customers. The cost does not really change that much. And that's the core of the issue, essentially. That's the opportunity and that's also the problem. What this means is that growing fast is imperative, right? If I grow fast, I make a lot of profit because my cost is flat. And if I grow fast, I can acquire the vast headroom which exists in this country. In fact, Runchana in her presentation in the beginning was showing the amount of underbanked people which are living in ASEAN, and it's remarkable how such a big market is still out there to be taken. And yeah, that's why digital banks are growing fast. But I'll also like to highlight, growing fast does not really mean that I'm cutting corners. When I'm building product, I'm building them to be scalable. That also means that I'm building the guardrails. I'm building the structure with the product. They are not addition to my product. They're essential to my product. So when I'm talking about risk mitigation, about compliance, about having the right operational processes, systematic processes, that is critical. And in fact, another thing which I saw in Runchana's presentation was that the operational risk and systematic risk were really immense for our industry, right? And these happen because when we are building, we kind of forget them as an afterthought. So to solve this, the first thing is we focus on what we are building. We focus on the right market, we focus on the right objective, and when we are focused on the right outcomes, automatically the product will grow. And for that, we don't need to cut corners. All of us have limited resources. When I say limited resources, it means limited money, limited people, limited technology bandwidth, sometimes even limited servers. And when I'm allocating those limited resources, if I allocate them to the right set of problem, the outcome will automatically be right. And that also means I'll have resources to make sure that the structures to protect me and to protect my customers are there. There's a second part to this question. And I said I'll keep it brief, so I'll be very quick here. But one of the data which I saw again from Runchana's presentation and Adrian's presentation also is that most of the people who are in digital banking or digitization of banking are actually not bankers. They are coming from all over the industry. They are technologists, they are bankers, of course. They are also e-commerce people and sometimes even FMCG people. I think I've seen one of the most successful bankers being an FMCG background. But what this means is these people are not really coming in with the ethos of banking. They are not coming in with the thoroughness which is needed when building financial product. To be fair, we are custodian of people money and we have to treat our products in the same sincerity. Our people are trusting us, our consumers are trusting us, and that is something which we as people working in banking and financial services have to value. And for that, today when I'm bringing people from all over the world to add their skill sets to digital banking, to help uplift the people of our region, we have to remember that they also are not just adding skill set, but learning skill sets to become a good banker. And that is something which we as organizations have to take care, which means having structures which prohibits them from sometimes doing things which may not be as prudent in banking. And at more often than not, just having learning programs to make them upskill. And yeah, I think that's how I would address this.
Thank you, Sajal, for sharing your experience with us. Now, let me open the floor for the comments or questions from the audience. So if you have any questions, please raise your hand. Okay, if there are no questions from the floor, we still have a few minutes. May I invite each of our panelists to share a short closing remark, just one key message you would like the audience to take away from this session?
Starting with me?
Yes, Sajal.
Okay, thank you. To give a short closing remark, I would say that what we have all seen, essentially banks are one of the earliest adopter of technology. We get to these technologies before anyone else does, but more often than not, we are the worst adopter of these technologies. And that's a dichotomy. Okay, let's just take chatbot as an example. I think 7-8 years ago, people in e-commerce were approaching me trying to learn how banks are using chatbot to do customer service. And today, when the whole world is doing wonderful things with AI, LLM tools, we are still on those old 7-8 years old chatbot which haven't evolved and customers still don't find value in them. Essentially, that's a characteristic of our industry. And I'm not saying it's a problem. I'm just saying it's how we are, right? And banks have increasingly becoming more and more complex. There is more and more data coming in. There is more and more interaction coming in. Today, banks are lifestyle. Banks are no longer just a transaction instrument which is doing credit and debit transactions. We are part of customer lifestyle. We are getting embedded in each and every part of customer's life. So essentially what is happening with all of this is we are becoming more and more complex. We keep on adding more and more new things into a bank, which makes it even more complex for our customers. And when we are working in a region like ASEAN, which is still developing, where people still have aspirations, we kind of realize a lot of our customers are put off with these complexities. So in future, what I do see happening is that one of the most important things that the bank has to do is use innovations and new technologies to simplify banking. Basically make us more approachable. That doesn't mean I need to have one product for all of my customers. No, that's not the case. It means I need to have one product unique to you as a customer. I should be able to take information about you, learn about you as my consumer, on the fly, in real time, generate an offering which fits you best, which is communicable to you in the right way and understood by you. And once all of these things get done, you as a customer will take my services and I'm sure will help uplift you as a user, will help uplift the region as a consumer, and also help us as a bank to make more profit and make more profitable transactions on it.
Thank you, Sajal. Pak Adrian, please.
Thank you. Digitalization has transformed the economy and also banking industry. It offers the opportunity to enhance the economy and also financial inclusion, and also support productivity and also growth. However, we must also understand and mitigate the risks associated with the digitalization. We talk about the risk in this panel this afternoon. So we need to ensure that the integrity and resilience of our banking sector to enable them to play a critical role as intermediary to finance the economy and gain confidence from our people, because at the end of the day, banking industry operates based on the trust and integrity. I will end my short remark by quoting a statement from Bank of Japan governor during the G20 finance minister and central bank governors meeting last year. He said, quoting, while digital finance expands inclusion and convenience, a critical challenge lies in harnessing the advantages of digitalization of finance while effectively managing risks to ensure stability of financial system. End of quote. I leave there. Thank you.
Thank you. Edmund, please.
I think what we are facing now is the new reality. So new technologies will continue to disrupt financial and banking services, and change is the only constant moving forward. Fintechs will also strive to position themselves along the financial mediation chain, as I pointed out just now, providing services to consumers, incumbent banks, and fintechs where there are efficiencies. So at current stage, we have yet to see the transformative effects from nascent technologies such as agentic AI, stablecoins, DLT, and also quantum computing. So experiments of this technology are still taking place in the financial sector. Disruption will be unimaginable. So are the regulators ready for this? Are they thinking about the risks that accompany these applications? How will that shape regulations? So therefore, regulators and supervisors should adopt a forward-looking yet prudent mindset, one that enables them to harness the innovative and inclusive benefits of the ever-changing tech landscape, while always stand ready to adjust or even revamp their regulatory framework in anticipation of wide adoption of these solutions. But at the same time, I will advise governments to also constantly upskilling themselves, learning from the best international practices from other economies as well as from solution providers. This can potentially provide them for a wide range of scenarios, reduce the bumps on their way towards a more sustainable, efficient, and inclusive digital finance future.
Thank you. Edmund, Runchana, please.
Certainly. So what I gather here is that, of course, as we see the two sides of the same coin, innovation versus risk. So I think collaboration is the key. So it's not just the regulators who should come up with the regulatory framework themselves. They probably need to work with the private sector, who's at the forefront of the technology, to come up with the optimal solution to balance well between innovation and risk. And this doesn't stop just within Indonesia, but also cross-border, because many of the digital products are now cross-border, stablecoin, etc. So collaboration, not just within the country, but also with other regulators and so on, international investors and so on. That would help. Thank you.
Okay, thank you very much to our panelists for a rich discussion, and thank you everyone for joining us today. Thank you.